before I go ahead with Action Construction Equipment, both Action and Sangvi, they're both into manufacturing space. Now, when you talk about manufacturing space, when you're talking about growth in general, when you're talking about GDP growth and everything, India can't grow also. That a country can't grow if the manufacturing space doesn't grow. You have to put a lot of investments in. Just give me a second. I'll have to close the door. The kids are. There's a lot of noise. Yeah, sorry about that. So the next thing what you're going to do is Action Construction Equipment. Like I told you, when you're talking about a growth in manufacturing space, when or when you're talking about the India's growth or GDP growth and everything, most of it comes like you can't have that growth without investing on proper infrastructure, right? You have to invest in roads, you have to invest in hospitals, railways and everything, all of this infrastructure. Now, most of these times, we might not be able to invest in, especially like a road company, because roads are constructed by the government, by NHAI, right? And you don't have that. You can't invest in Indian Railways also because one of the points in the checklist is, you don't invest in government companies or government stocks where the promoter is the government, because again the government doesn't work for the benefit of shareholders. So as a result, what you can do is, if you see a growth in this sector, you can start playing a proxy to this sector. Now, what do I mean by proxy is, let's say when I talk about railways, you can't invest in railways, or I can't invest in railways. The primary reason is because in my checklist because I won't invest in government space, because like I told you, the government doesn't work for the welfare of the shareholders, right? So what can I do is, I can play, if the railways are increasing, what I can do is, what are the other industries that are going to get benefited by the growth of railways, right? If the railways are increasing, or if there is a growth in railways, then the immediate thing that comes to my mind is, okay, there is bearings that goes in the railways, right? And who makes bearings? Rolex Rails. So who knows, they might have an order from railways, I can pick. So that way, or focus lighting, who knows, they might get a deal from railways. So the proxies, the industries that are going to get benefited by the main industries, this is called as proxy play, right? And why am I telling this is because right now, if you see, India is heavily investing on manufacturing space and the whole infrastructure. If you see the NHAI, they're investing heavily, I think around 40,000 crores in developing and construction of roads. Similarly with Indian Railways, I don't know if you've heard that Indian Railways is they're opening 400, they're starting 400 more, adding 400 more trains of Vande Bharat Express. In manufacturing space, if you track the electronic space, you would have seen constantly people talking about PLI scheme that the government is doing, right? So as a result of this, all of these spaces, because of all of these things or the initiatives by the government, the manufacturing space is seeing a big boom. Now, if I can't play roads and railways, I will see where they can cater. So these are the two companies that I see. One is Action Construction Equipment and the other one is Sangvi. Action Construction Equipment is, they make cranes basically. Now, up to cranes sabhi jagah lagta hai na, whether you're in the real estate, whether you're making railways, you need cranes everywhere. Any kind of construction you can think about, you need cranes basically to lift. So what do? They make cranes. If this is a product portfolio, as you can see, they have different types of cranes. They have construction equipment. I think these you would see in your local areas also, right? All these construction equipments, material handling equipments, which are basically like, rigging tools and all, and agricultural equipments. So so let's just see more about this. First is this is the company's world's largest pick and carry crane manufacturer, right? The second thing is they have the highest market share when you compare. They have 63 market share in mobile crane segment and 60% in tower segment. This is the tower segment. Can you see it is stationary? And the mobile crane segment is this one, like the pick and carry or truck crane, all of these, because you can move it from one place to another. That is what is mobile crane, right? And why I want to play this is because, see, they're diversified into many things: infrastructure, construction, manufacturing. Talk about it, they're all there. So let us see their revenue. 71% of the revenue comes from cranes. Construction equipment is 11%. Construction equipment is these backhoe loaders, wheel loaders, all of this. And then material handling equipment is all this forklift, and agriculture equipment is tractor combine. So this is your product portfolio, and this is where the revenue comes from, right? Now I am concerned mainly with this segment, as you can see, because 71% is coming from cranes, right? So out of this 71%, this is the breakup again. The real estate will cater to 10 to 12%, infant manufacture 45 to 50%, and logistics cater to 12%. So this is the breakup of the entire segment. That's one. right? Now let's talk about competitive advantage and threat. So what is the advantage here and what is the threat here? So here what has happened is, see, when you talk about cranes, it's of course, like, cranes are not, I mean, see, when you talk about an Indian family, it is very difficult to buy even a car, right? People go back and forth about it. So imagine a guy buying a crane. I mean, not like everybody would be buying a crane, but a company buying a crane, it's a huge investment, right? So of course, like, cranes that are coming from Germany, especially from Europe, these are high cranes, like very advanced and everything. But the problem with buying these cranes is, first of all, they're extremely expensive. That's number one thing. And the second thing is the payment structure. See, someone might not be able to, the company that is buying these cranes, they might not be able to make this one-time payment and buy. You would have seen with yourself, right? When you buy a car, most of y'all won't be able to make the one-time payment for car. So what will we do? You take an EMI on cars, or you'll make a down payment, and then you have a structure for the EMI. Similarly, here also, the crane business also is similar. If you're not able to buy crane giving one-time payment, what you do is you have an EMI, or you make a certain down payment. But here, even in this down payment that we talk about, or the EMI structure we talk about in crane, for the European business, it is crazy. Like, it is not, how do I tell it, the local players, the Indian players, cannot afford that, and the payment structure is ludicrous. That's one thing. The second thing, as a result, they come here. Ace company comes in between, to provide Indian-made cranes, homemade cranes, like India-based cranes here at a cheap price compared to the European. The another thing about disadvantage of European crane is, let's say your crane breaks down, maybe some part of it breaks down, and you have to get a replacement for that part. You're not going, like, right? So if you have to get even that replacement, it is very expensive. That is number one. And second is, you don't have those, how do I tell you, don't have those local dealers for those brands. So it becomes again very hectic for the whoever has bought these cranes. As a result, Ace comes in between, as a comes to gap, comes to what is that? Clear the gap between this European players. The second thing is Chinese companies. Now, the threat here is only the Chinese companies, because as you all know, if something Europe is making at expensive range, Chinese companies will make it at far way lesser price. So Chinese companies are also offering the cranes, but they're offering at way lesser price, and have a really good credit policy. Now, credit policies, maybe in 1 year, you have this EMI, and maybe that at a very low interest cost. As a result, this is the only threat. Now, what is the advantage Ace has compared to the European and the Chinese companies? One, Ace cut cranes are not as expensive as European. So again, here they have an advantage. The second advantage compared to Chinese, what they have is, in terms of price and credit policy, if you have to see, they don't differ. The Chinese company as well as Ace, they have the same credit policy and the same, the same payment structure, right? That is not. But here, how Ace is saving money is, whenever you have to import whenever these Chinese companies have to sell their cranes here, they pay a 7% tax. That's number one, the import tax. And plus logistical expenses also there, right? If you're getting something from China to here, the logistic expenses there. So here, adding 7% from the taxes and 7% from the logistic expenses, here you save 14% in and around by buying Ace crane. So this is their advantage, and also a threat here. Right. So let us understand what is the outlook, and what is the management commentary. So the management again is really bullish because of the amount of initiatives the government is taking, whether it's Atmanirbhar, PLI, and everything. They see a huge scope and a huge runway, right? And earlier, what used to happen is, export volumes were there at 4% last year. Right now, it is 6.7%. Why export? If export increases, it is also better, is because in exports you have much more margin compared to compared when you sell it to domestic. That's one thing. And going forward here, this will cater to 9 to 10% of the volumes, right? That is one thing, right? The guidance for the company is again to increase 15 to 20%. I will explain further how this 15 to 20% growth will come. That's one thing. If you see here also, in the crane segment, they've grown by 15 to 20%, 30 to 35% in the construction equipment segment. I'll just show you the volumes also. As you can see, the year-on-year volumes has increased, right? 53 to 65. Here also, construction equipment has increased. Material handling equipment and agricultural equipment. One thing with agricultural equipment here is, the reason for agricultural equipment, that is tractors and other things that comes in agricultural equipment. The reason here is, the government has come up with a new regulation. I think right now we are at BS3 and they have to go to BS4. As a result, what has happened is they've stopped the earlier whatever they used to produce, the BS3 tractors they were producing. They've stopped it, and as a result, and they have a lot of inventory of BS3, and they have to sell this off. And now, of course, right, whoever is buying new, they would want the BS4 regulatory tractor. They would want that, not the BS3 one. Because of that, the sales has been down. Again, this is just a seasonal factor, like it is just a one-time thing. There is nothing to worry about this also. The similar thing with even material handling equipment as a result. But like I told you, see, this is hardly about 7 and the other one is 10%. It's not a big, again, not a cause of concern, because crane and construction equipment is main thing for me, because cranes contribute around 71% of your volume. If you see here also, this is quarterly sales volume, that is Q3 to Q4, even that has increased. If you see here, material handling also has increased, and agricultural equipment, again, as I told you, because of that BS3 to BS4 change in regulation, is that we are seeing an impact. Other than that, everything is great, right? So yeah, so one thing I would like to talk about is the consistency that the management has performed, right? Earlier, I think when 3 years back, when they told they were at 1,200, I think they were making 1,200 crores of revenue or something, and they had doubled it right now, and they're at after 3 years, that is right now in FY24, they are making 2,400 crores of revenue. The management had spoken about this earlier, that we will double the revenue, and they've already done that by this year. So again, this year, from this year compared to the another 3 years, they will double the revenue, and from 2,400 crores, they want to double the revenue, and this would give you around, if I talk about, it will give you again 25% CAGR. But the management is being very conservative, and they're like, okay, we're going to grow by 15 to 20% CAGR in the next 3 years. So how will they do this 15 to 20% CAGR? If you see, you can see the amount of Capex that is being done here, right? If you see, first is they're setting up. See, when you talk about cranes also, there are different cranes, okay? Like there is 140 tons, 160 tons, and 180 tons. What is this 140, 160, 180 tons? Is the amount of load it can carry. So 160, 140 ton load, 160 ton load, and 180 ton load. So right now they have they're investing into making bigger cranes. I think 180 tons of cranes. They want to manufacture these bigger cranes. For that, they've done a capex of 35 crores. So this industry has high operating leverage. Can you see? They've started a capex, and they're going to invest 35 crores. That is the cost of capex that is going to take, and it will be completed by FY25 and FY26, and by that time it will start giving 300 to 400 crores. Here, if you can see the same thing currently, I think in their 140 tons or 160 tons, in that crane, they want to increase it by 40 to 50%. They want to do debottlenecking and increase the capacity production. This capex will cost them 40 crores, and this one will increase. And this will start by Q2 FY24. This will give them 700 to 800 crores by end of FY25, FY26. Just, can you believe it? Just 40 crores of capex is going to give them a turnover of 700 to 800. On the other hand, they have, like, again, forklift is their material handling equipment. There also they're planning to increase the revenue here, and they plan to add the land. They already have a land there, because the land that they have, the current plant that is there, it's very huge, and they can expand it. They can do a brownfield there and start it here. And here also, if they add it, they're going to give 100 and 150 crores. So totally, if I eliminate this, because having said that, they don't have a timeline as to when it will be all right. But these two, if I have to consider, just 35 and 40, the 75 crore capex is going to give them around, even if I take conservatively 300 and 700 crores, 1,000 crores of revenue. Can you believe? Just 75 crores. That is the operating. Can you imagine the operating leverage this industry can have, right? So this capex is in turn going to fuel that doubling their revenue in the next 3 years. This is the plan for them. So as this capex will start to progress, you can see that being converted into the top line, right? And if you calculate all of these three, it will add up to 1,200 to 1,400 crore in revenue. So now this makes sense, right? Because right now with the existing capex and the existing sales, plus add this 1,200 to 1,400 crore revenue. So this is a plan to increase the revenue from 2,400 crores, doubling the revenue in the next 3 years. That is by FY26. Yeah. So yeah, if you see the result also here, they have done pretty well. One second, let me just open the Action Construction Equipment Limited. So first thing first, we'll check our income statement, right? In income statement, I'm going to check for consolidated. I don't want to check because if 95% of my revenue is coming from export and 94% of my revenue is coming from export and 6% is coming, 94% is coming and 6% is coming from export. I want to check the consolidated also. So if you see here, revenues have increased. If you see, the total income has increased, right? Both quarter on quarter as well as year on year. There is not much difference when you talk about other income also, hardly any. In fact, if you see, the other income has reduced 7 point last quarter to this quarter. So other income is nothing. If you see even the PAT here, yeah, the PAT is a 0.9% QOQ and 33% year on year. So the reason for PAT being down QOQ is because they have a defect tax. Because of that, again, not a cause of concern because it's a one-time thing. And they have a one-time exceptional item of 19.7 crore, right? That is also there. So other than that, you can see that the PAT margin is at 7.6. And let's just, so that's that. If you see in the income statement, if I have to further go and just open, yeah. If I see here also, there is no asset liability mismatch, right? If I see total current assets by current liability, the current asset is always greater. I don't want to do, the reason I'm not doing all the quick ratio and those kind of ratios here is because manufacturing space, when you talk about it, auto ancillary space, like I mentioned earlier, these are sandwich business model, right? So anyways, their inventory days will be high. Their receivables will be high also. Payables also will be high compared to other industries. So it is not fair. It is not the right comparison to do. So just if you check the asset liability mismatch, there is none asset liability mismatch. This next I want to see is the CFO or the cash flow from operations. If you see here, the cash flow from operations has increased from 137 crores to 233 crores. That's one thing, right? Yeah, just a second. Yeah, you can see that the cash flows has increased from 137 to 233 crores. So it is an increase of 70%, right? After that, if I have to just check from the cash flow where the money is going, right? If you see after all the working capital changes that are there, operation before the working capital changes, if I have to consider depreciation, amortization and everything, even after that also it has increased from 171 to 256 crores. That's one thing. After that, if I have to see the working capital adjustment, right, just check the trade receivables. Earlier it see if it is a negative, which means money is going away from the company. Now this could be because again, it's not a big amount, it is hardly 2.21 crores. It just shows you that they haven't received any payments. The 2.21 crores is a negative because maybe there is some problem with the payment structure. I don't want to go into depth in this with the receivable and payable here, is because every cycle, the project of every cycle with action construction equipment you talk about, like, or with RECL, it is 9 to 12 months. So we don't know the payment structure here also. So as a result, I won't go deep here. If you see the payables, increase in trade payables has gone 33 to 91 crores. It just shows that these people might not have good relationship with their whomever they're sourcing the raw material from. They don't have that bargaining power. They have to give it up, first hand. So that's one thing. After that, if you see, net cash from operating activities also is still positive, 103 to 274 crores. In fact, it is increased, right, by 2x. See, after all this 274 crores that you have, the total cash flow from operating activities you have, when you go for cash flow from investing activities, it is becoming negative. What is the reason for this? If you see, can you see a purchase of investment? There is a purchase of investment of 525 crores. Now, what is this purchase of investment? This purchase of investment is the money that has been invested in mutual fund. If you can see, last year also they had invested 147 crores, right? And I think they made 360 crores by selling the same investment, 147 to 360. They probably invested some of that here and taking the total investment to 525. This is in this. I went to their annual report and I saw it has been invested in various mutual funds. So यहाँ पे 274 है और investment है यहाँ पे 525. So 274 to 525, of course, right? Minus negative 217. You can understand that why it has been negative here. And the other part, like I told you, 75 crore of Capex is being done, which is going to give them a turnover of 1,000 crores. कहाँ पे वो 75 crores का revenue था, like I told you, 35 crores is going to invest in the in the big cranes, 180 crores or 40 crores is being invested in the to debottlenecking of the existing cranes to increase the production by 40 to 50%. I remember the capex plan that I gave you. This is the same capex, as you can see, 73 crores यहाँ पे चला गया है. Now this is not a cause of concern. I'll tell you why. You see here, if I go back and see, one is my book value has been increased, right? See, although I know they have invested 525 crores, in spite of that, if you see, the book value has been increased by 22%. Now, if I do net income by divided by your equities, if I see that even your ROE has increased from 13.9 to 18%, right? My book value has increased, my ROE has increased. On top of that, let me see the debt here. Yeah, lease liabilities, if I take the lease liabilities also 1.25 crores to 0.6 crores. Lease liability has come down by 50%. Borrowings आप यहाँ पे देखोगे 29 crores to 6.6 crores, 6.2 crores, right? Borrowings also has reduced significantly. ये आपका short-term borrowings है, right? That is the borrowings that has to be repaid within a year. Even this has reduced significantly. And on top of that, they're increasing the capex. आपका 75 crore का capex में, if you're getting 1,000 crores of revenue, how much more capex will you do? You can't do like capex just because you have money, right? Just because आपके पास पैसा है, you can't keep doing the capex, because these are highly cyclical industry. When you talk about ACE, Sangvi and all that, right? And एक बार cycle जो घूम जाएगा, what will you do with all the capex that you have done? You will again go back into debt. So as a result, they just can't do like unshent capex and sit. As a result, this whole 525 crores makes sense. See, this 525 crores would have pinched us if, say, let's say, the debt has not been reduced, ROE has not improved and everything, and they still ended up doing this investment in mutual fund. That would have been a cause of concern. Or let's say they didn't have any avenues for growth in A, and then they're keeping the money in their books. That would have been the concern, but that's not the case. There is growth, and they're investing heavily in capex to cater to this growth and the demand. And in spite of that, they have still cash. Now, what to do with this cash? They can't just keep it simply in cash. They might as well get at least that little bit of interest. So that is why this 525 crores ka this investment is there. So that is all to be covered in ACE. So that's with this. I've covered every point here, right? The CFO is increased. Like I told you, CFO by PAT is 0.85, which means what the company, ideally we would require CFO by PAT to be 1, but as you see, this is a manufacturing company, receivable and payable, there will always be that gap, the contract might take a lot of time. So as a result, I don't expect also but having said that, 0.85 is a good deal, right? Working capital, inventory has increased, receivable and payables too. Like I told, we can't comment on this. And if you see also, it is not a huge increase, right? If I have to show it to you here, where is inventory? Current assets. 332 crores to 417. Again, because see, these, like I told you, why the inventories has to be high, why the receivable and payables also has to be high. That there's a reason for that. Like I mentioned in RSCL, it is the same here also. Yeah. So I've covered everything here in ACE. So the next company is Sangvi Movers. So Sangvi Movers also makes crane. The same, they are also into cranes. But what is the difference